morning and welcome to NYSE TV Live. I'm Trinity Chavez in studio here at the New York Stock Exchange. Well, hotter than expected wholesale price inflation data on Thursday weighed down the major averages. Meanwhile, the 10-year Treasury yield often acts inversely to how equities are moving, jumped to its highest level in 2 weeks, ending Thursday above 4.3%. But we made it to a very busy end of this week here on Wall Street and especially at the New York Stock Exchange. Here's what's on tap over the next hour. On the heels of Warner Brothers Discovery announced that it will be splitting up its cable and streaming businesses, Seth Schackner, managing director at Strat Americas, will tell me more how this will impact the future of entertainment in both the short term and the long term. Elsewhere, the National Association of Realtors has revealed which U.S. markets it projects to be the hotspots for the housing market in 2025. Lawrence Yoon, NAR's chief economist and SVP of research, will tell us about what stands out about these regions. And at 9:30 a.m. Eastern, NYSE-listed company Timken will celebrate its 125th anniversary of founding by ringing the opening bell. The company's chief executive, Tarak Mehta, appointed this past September, will do the honors and kick off the final trading session of the week. And of course, we'll be keeping a close eye on the markets as we always do here on NYSE TV Live. For more on this, Frank Cavallari, founder and president of Cap Thesis, is joining me now. Good morning, Frank.
Hi, Trinity. How are you?
I'm great. Thanks for joining us on the show this morning. Now, the S&P 500 has reached your 6,100 price target. What needs to happen for the index to maintain its uptrend, and how should investors approach it from here?
Obviously a great question, and I also get asked a lot, how did we get here? And the answer to both questions is actually the same. And so this has been really a series of breakouts from a smaller basis too. So even before getting to 6,100, the S&P 500 has achieved 10 different price targets all along the way. And all that means is we had digestive phases along the way, right? And they have gotten resolved to the upside more often than not. Now, eventually, at some point, digestive phases will form bearish patterns. We'll see downside targets hit. But we can't jump the gun with that because it hasn't happened. And we can go back to 2022, we know how that looks and feels, but all on the way up to 2021, we had to wait for something to change. So a market character change would be seeing, one of these consolidation periods actually see a downside break. And when that happens, it typically happens quickly as well. But I think we have to be patient because we've seen what's been going on over the last 2 years. It's been an uptrend. Uptrends are created by successful bullish patterns happening.
And Frank, only 3 sectors are positive this month: consumer, discretionary, communication services, as well as tech. What needs to change for other sectors to find demand and support broader market strength?
Well, if you look at the sectors that are up, of course, they're the large cap growth areas. And so, it gets a lot of attention, especially when all of the biggest names are making new highs. And it seems like it's been happening all the time. But if you look at it closely, this 2-year bull market, yes, it's been led by tech, but the bedrock of this has been rotation. When those areas have started to come down a bit, then that's when we see rotation back into, say, financials, industrials, and that really needs to happen again. So as we know, Trinity, the S&P 500 has had negative breadth every day so far in December, but those breadth numbers haven't been too severe. So at some point, I think you will see rotation back into these other areas, which really needs to happen for this market to continue higher.
And December has historically been a strong month for markets. What do you believe is the biggest thing behind the recent pullback? And do you believe that this will continue to persist?
I just think it's a natural cause of events when you have the market get too extended, say, on the short term. We look at this, over the S&P 500, we can put a trading channel on the price action going back to the August lows. And all along the way, it's kind of oscillated in between the extremely on the high point and the low point. And so it got a little higher. So I think this, for the most part, we're seeing a normal pullback. And I wouldn't be surprised at all, again, to see the other sectors that have been lagging and eventually get a bid, which would then support the rotation theory and have the market potentially finish near its highs again toward the end of the year.
Now, utilities, energy, and materials have really been hit hard in December, down over 5%. Do you see this as a buying opportunity or a sign of broader weakness?
I do think it's a buying opportunity. I think utilities is a very interesting one, of course, because it was leading for most of the year. So came into December up 31%, now down 6%. And if you look at the XLU ETF and some of its components, it's kind of right near some key trend lines and previous areas that I broke out from. So again, if this buy the dip mentality is with us, I think investors will be looking to other areas that are not extended, that have come in right now. And again, getting back to the rotation theme, I think now is a key area or a key time for that to happen again.
I do want to go back to your point about ETF. So the financial ETF has avoided breakdowns multiple times this year, but is now showing another bearish pattern. What would signal a rotation into this sector, and how critical is it to the overall market health?
Very critical, of course, one of the biggest sectors underneath technology. And again, going back to over the last number of months, it's formed pretty clear bearish formations on a multi-week basis. And we've seen XLF attempt to break down from there, but every time that was about to occur, that's when buying came back in. And so if you look at what's happened now since the spike after the election, same type of thing. It's been kind of moving back and forth. It has shaped another head and shoulders bearish pattern. But I think, again, that's set up for the market to eventually take advantage of that, and that could turn into a bear trap with new highs to follow right after.
And you know, NVIDIA is showing a similar pattern to last fall before its explosive rally. Do you see a repeat of that move, or are the current conditions signaling a different outcome?
Well, first we understand that it's not apples to apples, right? We're up 245% since the last time that bearish pattern failed in October of last year. At the same time, we can see that NVIDIA, again, amazing run, but it's had some multi-month consolidation phases along the way. Each one of those has been taken advantage of. So I wouldn't recommend shorting NVIDIA or something like that because of the way it looks. And I do think it has the ability, again, to have demand come back into it and become a leader. And that's important as well, because if you think about large cap growth, it's been leading, but semiconductors have lagged. So a big part of the market of technology has not even participated in this advance we've seen with large cap growth. So if there's going to be rotation, there could be rotation within technology as well, back into the semiconductors, and that could really provide what we need for another up leg to take hold relatively soon.
Now, Frank, we have about 45 seconds left here. I do want to get your take on, as we close out this year, what do you see as the biggest risks and opportunities as we go into 2025?
Well, I think just understanding that this is 2 years worth, two 20% years in a row. So the question is, will the market run out of steam? Right, and of course, we have a new administration coming in as well. So there's, of course, always uncertainty, but at the same time, from a price action perspective, I think we have to look at it the same way. Are the trends still in place? Are these consolidation phases that we're seeing taking advantage of the way they should? If not, then of course, we'll have to be on guard for a potential rollover and the next volatility event may not be as viable as we've seen in the past. And I think all that will reveal itself as the new year begins.
A lot of key takeaways there, as always. Thank you so much, Frank Camilleri. He's the founder and president of Cap Thesis. Thanks for joining us.
Thank you, Trinity.
Coming up, one media giant is drawing up a new game plan for its cable and streaming assets. Find out what it could mean for your viewing experience. Up next.
So now, Eric, this year, GIC is celebrating 40 years in the United States. What has this journey looked like for you?
We are so proud to be celebrating our 40th year in the US. In 1984, we opened up a small fixed income trading shop here. And the idea was we were a global investor, but we wanted to be local. And we thought it was really important to meet your partners in the market, get to understand the trends, and be there with the businesses that you're invested in. So we opened up our first office in what we thought was the most important market, the United States. We opened up an office 2 years later in San Francisco. And amazingly now, even 40 years later, we've got 11 offices around the world, and these are still combined our two biggest offices in the world. Along the way, we've also diversified what we do. So I mentioned we started with fixed income investing, but now all of our asset classes are invested here. So public markets like fixed income, public equities, our hedge funds business, but also our private markets, our private equity team, our infrastructure team, our real estate team. And the US has continued to grow in importance as a part of the portfolio. So it's now almost 40% of the overall exposure.
Now, Eric, tell me, what opportunities are you seeing in today's market?
Well, we always say prepare, don't predict. We do believe as investors and long-term investors that you want to be diversified. So if you look at our portfolio, it's globally diversified. It's also diversified across asset classes. But we do like to look for long secular themes. And so two that we are interested in are digitization. So we've seen a long tailwind on technology, and in particular in the US, which has been a real market leader for the last 20 years. We believe AI is really revolutionary technology, and we're investing in that space in a series of ways. A second would also be decarbonization. We do think the planet is getting warmer, and so there will be significant capital invested against mitigating that. And so over the next decade or two, we do think this is a huge opportunity for firms like GIC that are really focused on investing in these long-term projects, providing long-term solutions.
Welcome back to NYSE TV Live. I'm Trinity Chavez in studio above the trading floor at the New York Stock Exchange. On Thursday, Warner Brothers Discovery announced that it will be restructuring its business into two separate units. The global linear networks side will include cable channels like CNN, TBS, and TNT. Meanwhile, the streaming and studios portion will house the Max streaming channel as well as the company's film and entertainment studios. Warner Brothers Discovery says that this decision will likely take effect by the middle of next year. To talk more about this is Seth Schachner. He is joining us now. He is the managing director at Strat Americas to talk more about it. Good morning, Seth.
Good morning. Good to be here.
Thanks for joining us. So what do you make of this news? Do you see it as a smart strategic move by Warner Brothers Discovery, and why?
I think it's kind of remains to be seen how smart and strategic it is. And I think for sure a lot of the legacy studio systems here are kind of doing their part to set the stage either to sell or trade or merge some of their legacy, pay TV and linear television businesses. And that's what this split is all about. Their competitor, Comcast, has done it, I think, in probably a more strategic way. And I think Paramount's looking at it as well. But yeah, the idea, I think, will be to set the stage so that they can either sell or do something a little more strategic with those old TV channels. But I don't know if we're ready to call it successful just yet.
Now, do you think that the move, though, was essentially a plan to make future deals and perhaps a potential sale?
Yeah, I think it's very clear. I mean, the odd thing about pay TV or linear television, Wall Street, I know I'm speaking to to Wall Street this morning, I think looks at these things as legacy dying businesses. They actually still throw off a lot of cash flow. And I still see it as an entertainment, and media practitioner, not just an analyst, as still an important part of the ecosystem. So I think clearly they're looking to do something with it. It would likely be a sale or a merger, and you can sort of forecast what a lot of those will look like. But, I'm not one who just jumps on the bus and says, sell them all. You got to get rid of them right now and just maximize the stock value, because I think even some of these legacy networks have an important role to play in the media business ecosystem. So I look at it, a little cautiously right now to see what's actually going to happen.
And this is the second major shift by a media giant in the past few weeks. Comcast recently announcing its plans to spin off several of its networks. What makes this situation different?
Well, Warner is a different beast than Comcast is much bigger, has got everything from theme parks to it, and and actual cable operations, and they can kind of afford to do that. They don't really need the cash flow. I think Warner is a little bit different because it's more, to me, of a pure play entertainment ecosystem, part of business, even with the Discovery merger. And they have some super strong assets on HBO, and I think what they're doing in terms of combining the assets will be very interesting in terms of theatrical releases, in terms of advertising, even in terms of things like rights with sports, where all these studios and networks are competing for it, in some cases losing out to the tech titans. So I think Warner is a very core Hollywood studio, and I don't know, personally, I don't want to see the whole thing just be plunked apart and sold, basically. And it's a little bit different than some of the others for that reason.
And as we're seeing cable declines, and we're also seeing a plethora of TV bundles, streaming bundles on the rise, what does this deal say about the overall business of TV and streaming businesses?
Well, it says that I think, over the next year or so, these media mergers and media transactions are going to keep happening basically because there's competition for everything you just mentioned across the board. And some people are theorizing that, with the new administration, there'll be a little bit more of a hands-off attitude setting the stage for that. And that's what people have been, sort of putting on David Zaslav in terms of why this is happening. I don't think a lot of these mergers have actually stopped if you look at the last year. So I think we're still going to be in this state of transformation and a lot of competition from the tech titans, which are going to be competing across the board. And that's kind of why Warner is doing this. They also need to make those streaming services profitable. So, cost cuts and consolidations, maybe you'll see that over at Paramount in terms of overlapping TV networks they plunk together. So it's still going to be a time of transformation over the next year or so.
Seth, I do want to get your long-term take here. How do you think that Wall Street analysts are viewing deals like this?
It's a great question. I think Wall Street clearly shifted from telling streaming services and studios just to go and grow. And I think they've become a lot more focused on profitability. And I think that is, in essence, kind of a follow-on to what that phase was all about. So I think, the next year or so will probably be, does it make sense to put, these streaming services or these television networks together, basically? Maybe that's a Comcast Paramount combination. Maybe Warner, would combine, because ultimately they're all competing with the big entities like Netflix and Prime. And so I think the street will probably look at it strategically that way, moving just beyond the focus first was on consumer acquisition and then on profitability. So be a new phase, definitely very interesting.
Now, we have about 45 seconds left here, Seth, but incoming President Donald Trump, he was here just yesterday bringing the opening bell. How do you think the upcoming administration, this deal with the cable wars and buyouts, what's your take on that?
It's interesting. I don't know just yet. I think that some of the regulators I've heard that have just been proposed are tough. And not folks that you can just say are going to be hands off and let anyone do what they want. I do tend to think it'll be business friendlier, and there will be a little bit more space for maneuvering. For sure, President Trump understands this ecosystem in business more than others do. So I tend to think it will be more deal oriented. There'll be perhaps a little bit less regulatory interference. But some of these transactions that are been the Skydance Paramount transaction. This one, if it gets merged, will certainly be things that the regulators will look at. So I don't think it's going to be a radical difference from the last 4 years. But I think it'd be an interesting thing to watch when the new regulator gets in.
A lot to look out for right there. Thank you so much, Seth Schachner, Managing Director at Strat Americas.
To be here.
Coming up, the National Association of Realtors has identified 10 U.S. metropolitan areas that could see the most success in the housing market next year. Find out what they are up next.
Fiserv serves fundamentally every American household. Largest payment processor and largest fintech in the world.
I do want to talk about Fiserv's third quarter report. It was showing significant growth, and especially when it comes to merchant solutions. Can you talk to me about what you think is fueling this growth and how you expect to continue that momentum?
We had 28% revenue growth in Clover. Our regions outside the U.S. also are growing very, very strong. Our commitment to small business, our commitment to innovation, along with our e-commerce capabilities. So, being able to serve every household across the U.S. and then in multiple countries has given us great geographic diversity and given us great capability from the largest retailers to the smallest pizzeria.
And you actually just recently announced your partnership with DoorDash on the Crimson program. Can you talk to us more about that and why this is such a significant milestone for Fiserv?
So what we did was create a solution set for DoorDash that allows them to be able to bring a better experience to their drivers, the Dashers. And it's really an integrated approach. It's using a series of products we have. We brought a couple of partners in, both in banking and in some other expertise, but ultimately it's our core product set.
How will this help kickstart Fiserv's expansion into other sectors?
Well, I think in fact it is an opportunity to show how we sit at the intersection of banking and merchant. You know, we are the only property that can sit at that intersection, that we could deliver payment processing, Clover, to a bank.
Welcome back to NYSE TV Live. I'm Trinity Chavez in studio. Potential home buyers are hoping for a more active housing market in 2025. A new data released just yesterday projects that, exactly what could unfold? The National Association of Realtors has named what it expects to be the top 10 housing hotspots for 2025, with a majority of them residing in the South and Midwest regions. NAR Chief Economist and Senior Vice President of Research, Lawrence Yoon, is joining me now to talk about what these developments mean for buyers, sellers, and the broader economy. Good morning, Lawrence.
Good morning. Thank you for having me.
So what specific economic, demographic, and housing factors were most influential in identifying the top 10 housing hotspots for 2025, and how do they differentiate these markets from others?
We looked at about 300 metro markets across the country, and it looks like the factors for more activity, more buying activity, more millennials able to get into the market, vast majority of the market. But we also wanted to identify who were the top 10 markets. And essentially, places like Hartford, Connecticut, Indianapolis, Kansas City. So what we are finding is that areas where we are seeing inventory growth, because lack of inventory has clearly hindered some of the first-time buyers, and also where the jobs gains are very robust, places like Phoenix, San Antonio. So we were looking at where the job growth, migration pattern, so various factors which we think will lead to a very upcharge activity in 2025.
And, as you said, the South and Midwest regions feature prominently in the top 10 housing hotspots. What factors contribute to their dominance, and how might other regions improve their housing market dynamics?
Places like Grand Rapids, it's been facing severe inventory shortage, even with the job growth, but it is still relatively affordable compared to rest of the country. So when you look at, market which is very pricey areas like the California market, activity can rise, but not to the extent because of the affordability challenges. But we were looking at where the millennials are moving into, where the job growth is strong, and where the income growth among the millennial population is rising strongly in places like Boston, and the increase in supply that is coming onto the market.
Now, I know you and your team are expecting mortgage rates to stabilize near 6% in 2025. How might this new normal, so to speak, impact buyers' confidence and overall market activity compared to previous years?
When we had that 3%, 4% mortgage rate back in the immediate years after the COVID, those were special, exceptionally low mortgage rates. Now that the consumers have adjusted, getting used to the fact that mortgage rates has been bouncing around at 7%, but with the Federal Reserve expected to cut more rate cuts throughout 2025, we think the mortgage rate will settle at 6%, which is slightly below long-term 50-year average. So as consumers see stabilizing mortgage rate and continuing job growth, definitely based on how the stock market has reacted post-election, it looks like business confidence is up, business will invest more, business will hire more people. So job growth, stable mortgage rate, rising inventory, these are all good factors to boost home sales in 2025.
But Lawrence, with the $410,000 on average median existing home price right now forecasted for 2025, what strategies can prospective home buyers employ to navigate affordability challenges in a competitive market, as you mentioned?
First, stay well within budget. So one do not, if one has more moderate income, one should not strive for that medium-priced home, but look for starter home, which is below the median, and it may require, say, looking at outlying regions. So rather than closer to the inner suburbs, maybe it's the exurbs which offer better affordability. And also look for the mortgage rate. Some people, younger people, they rarely stay in their home for 30 years. So maybe not the 30-year fixed rate mortgage, but adjustable rate mortgage, say a 7-year fix, and after that it adjusts. But people would then move within the 7-year time period, and adjustable rate mortgage, given that the Federal Reserve is cutting interest rate, will be more attractive.
But beyond affordability, what are the most pressing challenges right now the housing market may face in 2025?
Well, we have had this ongoing housing shortage. You look at the U.S. population, you look at the job growth, how many new units need to be there, and we estimate around 4 to 5 million housing unit shortage. It was in place even before COVID, but still ongoing, lingering, and therefore we need to boost supply. President Trump has implied that he may open up some slice of the federal land for more development, more housing construction, along with deregulation, which is bringing some optimism among home builders. But local city officials, they really need to look at how to boost supply. Boston has done very well in terms of trying to build more multifamily housing near the rail station so that, it has less environmental impact, but also where young people, they like to live in the downtown areas. So one has to look at all factors to boost supply. Supply has been the major constraint. Any policy to boost supply will be very helpful for the economy and for home buying possibilities.
And we look forward to continuing this conversation with you on NYSE TV Live. As always, it's a pleasure. Lawrence Yoon, NAR Chief Economist and Senior Vice President of Research.
Thank you.
Now stick around. One NYSE-listed company is celebrating a milestone moment by ringing the opening bell just after this break.
If I go back to 2021, it was really the first time in the company's history that we actually had an investor day where we showcased our first essentially 3-year strategy for the group. And it was very clear, very focused strategy. It was really about diversification, about the fact that we wanted to increase the franchise value of our reinsurance business, but we also wanted to get scale and expand on the insurance franchise. Once you have that roadmap and that vision and you have excellent people, it's amazing what you can accomplish. And I look at where we are now, 5 years later, basically. The company has more than doubled in size. Our stock has gone up over 60% over that period of time, better than the S&P. Our book value per share, which is a critical measure in insurance, is also up over 60%. And we have improved pretty much every facet of the company, from underwriting discipline to operating discipline. But one of the most important things we have done is we have created a culture of inclusion and collaboration. That's frankly what allows us to accomplish what I just discussed. One of the great things about insurance is that we have jobs for everybody, regardless of where you come from. But no, I did not think that insurance was going to be where I ended up. Mm-hmm. I had gone to the Johns Hopkins School of Advanced International Studies for my master's. I have a master's in international economics. I speak 3 languages, and I had a lot of experience in Latin America. So I thought there's got to be a multinational company out there that could use somebody with my talents. But I didn't know what industry, and I didn't care what industry at the time, to be perfectly honest. So I had applied to different companies. And the way I ended up in insurance is my older brother, who had worked for McKinsey & Company for a long time, had said, listen, AIG likes people with your background. And for me, diversification is about a few things. It's about geography. It's about line of business, so property insurance, casualty insurance, aviation, different kinds of things. It's about insurance business and a reinsurance business.
Welcome back to NYSE TV Live. I'm Trinity Chavez, and we're about 10 seconds out from opening up the U.S. equity markets. Timken will ring the opening bell to kick off today's trading session. They are here celebrating 125 years. Let's tune in. And we are officially off to the races. The U.S. equity markets are now officially open. You see right there on screen the Timken team along with Chris Taylor there on that bell podium, kicking off the day of trading today on a Friday, celebrating 125 years since its founding and over 100 years of being listed here at the NYSE. Switching gears a little bit now, joining me is James Demert. He is Chief Investment Officer at Main Street Research. Good morning. James, I believe that your audio is a little bit low right now, so if you have the ability to turn it up, I think our viewers might be able to hear you a little bit better, but
Gotcha.
There we go. There we go. It's all good
Better?
now. Okay, perfect. So let's just get into this conversation. You expect the S&P 500 to hit almost 6,200 by the end of the year. What's driving this rally, and are there any risks investors should watch out for?
Yeah, between now and the end of the year, that's our target, and that's really based on most recent information that we've had, right? Inflation numbers are not too cold. The economy at 2.8% growth, not too hot. That's a perfect setup for stocks, and you still have money on the sidelines, much of which got sold before the election in fear of that, piling in to look good by the end of the year. So we think that Santa Claus rally has got some turbochargers on it and could get us up that high by the end of the year. The risks to that is that maybe the Fed doesn't cut next week. I don't think that's a high risk. I think they will. I do think, however, there's risks in 2025, particularly in the first quarter, that will relate to the Fed, which we can chat about.
Now, there's somewhat of a sentiment that under-invested investors are feeling a little FOMO right now. So what's your advice for those hesitant to invest at these sort of levels?
I talk to some of them once in a while as they interview our firm, and there's quite a few investors who've just really not understood the AI tailwinds and all the opportunities, so they've missed out. And our suggestion to those investors, which is in my last book about market psychology, is to be patient. This market has really not had a correction of any significance since the summer. It will have one. That's how markets work. We think there's a correction due, probably a very startling one, in the first quarter of 2025. And that's going to be an excellent window for investors who have that FOMO, if they can wait that long, to push into that correction, because we think 2025 is going to be an excellent year for equities, but definitely have more volatility. And our target for 2025 is 70.50 on the S&P. So if you can buy that dip, you're going to look great. But I would suggest highly that be patient before we get there.
James, I want to lean into this conversation a little bit more. You predict about a 10 to 15% correction in early 2025, especially in AI-related stocks. So how can investors prepare for this?
Well, I think, first of all, prepare emotionally. Investors have gotten so excited, so euphoric, and they sort of lose track that normal corrections are usually around 8 to 12%. We think this one might be a little bit more volatile because a lot of people made a lot of money. So first of all, prepare yourself emotionally that can happen, but also look at the macro and say to yourself, okay, if there is a correction, the market still goes to new highs by the end of 2025. So emotionally prepare yourself. At our firm, we're more tactical, so into the beginning of the year, we will be pruning back some of our biggest winners, NVIDIA's and the semiconductors, to sort of level the portfolio out a bit and provide some cash for opportunities into that dip. We think 2025 is going to be a different market, not necessarily the center stage be the semis. We think it's going to be second derivative tech and some other sectors, which I can talk about.
And AI is also another hot topic, especially here on Wall Street. And, it is driving earnings and valuations in the years ahead. So which sectors will benefit most, do you think?
Well, think about it this way. I think investors should think, the picks and shovels, the semiconductors really win the war in the beginning of these big bull markets. But what happens next is, A, the economy has greater productivity growth, right, which is great for all companies, but specifically those that embraced AI, that were early adapters, what I call second derivative, the companies that really, the hyperscalers and the companies that bought AI. So that's where you really want to go to the sectors like telecommunications and technology that aren't the semis, but maybe the software and the networking companies. But also, don't be afraid to go to healthcare, where there's been tremendous investments in AI. Don't be afraid to go to some of our other favorite sectors, which is financials. Jamie Dimon investing tremendously in AI. Plus, they've got, of course, moderated interest rates. Industrial companies, really successful there. And I love the utility sector because we've got to build that out. We don't have enough electricity to serve all this AI and EV. So we need a bigger grid. Lots of companies can benefit from that.
Now, I do want to ask you about what investors can anticipate come 2025. How can they manage the volatility that you expect in the early first quarter and take advantage of potential buying opportunities, especially with the new administration?
Yeah, I love that question because this is going to be a different year, 2025 than 2024. Stocks are not going to be driven by the Fed or all that cash on the sidelines. It's going to be like earnings and the economy. So investors, if you're not fully invested, you want to wait for that pullback. If you are fully invested here, prune back some of your big winners because the leadership in 2025 is going to be different than in 2024. So some of those semiconductors will still do well, but there's opportunities in other places. So I would suggest pare back some of your big gains. Maybe if you want to wait for the tax year to change, do it in the first week of January, and then set yourself up ready for any pullback in the first quarter we expect to go into these other areas which I just mentioned in those other sectors.
James Demmer, Chief Investment Officer at Main Street Research. It's a pleasure.
Great to see you.
Coming up, one company just announced a brand new solution for crypto payment processing. Stay tuned for the details. You're here at the New York Stock Exchange for our annual Space Summit. This is your first year attending. Talk to me about why it was important for you to attend.
For decades, space was not really talked about, and particularly in the world of investing and early stage investing, it was not a smart investment to make. It was not viewed as salient or viable given the long time horizons, the capital intensity, and that is all changing. So all of the work that the industry has been doing behind those closed doors, behind the curtain, is now coming to fruition. And so the best time to make these investments, especially in early stage, is just before something is about to happen and having that timing exactly right. And so that timing is now.
Talk to me about, from your standpoint, the criteria in which you consider before deciding who you want to invest in.
The fact of the matter is 776 is a generalist firm. And so this is not our deep area of expertise. We are an inch deep, a mile wide across different sectors, which is a beautiful position to be in, to really understand how all of these economies fit together. And for me, the interesting thing about space is that they're actually creating their own new economy. And so the in-space economy for me is wildly fascinating. And the opportunity, from an investment perspective is massive. And the opportunity and the capabilities that this is going to breed for us here on Earth, for humanity, the human side of this is absolutely fascinating for me. And so we typically make one moonshot investment per fund. And so we're relatively new to the space as investors, to the sector, I should say.
Yeah,
the sector of space, yes. and so I'm really here to learn. I'm here to understand what people are talking about, where the industry movers and shakers are. But the deeper I get into this, the more and more obsessed I've become.
And where would you say the different areas in space are you targeting right now?
There's a lot of...
Welcome back to NYSE TV Live. I'm Trinity Chavez. The price of Bitcoin is sitting around $100,000 a token during the first half of December, and one company is looking to make crypto payments easier for businesses. Global workforce management and payments platform Helios has just unveiled plans that they will offer additional flexibility in how companies pay global teams leveraging cryptocurrency to fund payroll requirements. Helios cryptocurrency payroll funding solution will be launched next month, and the company says that the solution will support the top 17 cryptocurrencies and that their payments will instantly be converted to fiat OTT currencies like the US dollar. Joining me now is Rick Hamill. He is Helios founder and CEO. Good morning, Rick.
Good morning, and thank you for having me.
Now, with cryptocurrency hitting record highs and a renewed political push from President-elect Donald Trump, what prompted Helios to launch this crypto payroll solution at this very moment?
Well, actually, to be honest, it's creating more flexibility for employers. We realize that a lot of businesses are trying to take advantage of cryptocurrencies, and they're leveraging in their day-to-day business operations. And so, as we think about global payroll, our mission in life here is to make sure that we're creating flexible opportunities for all businesses to be able to expand globally. And cryptocurrency is only going to allow that to make it a little bit more simplistic for businesses and how they pay their global teams.
And how does Helios's cryptocurrency payroll solution align with the broader trends right now that we're seeing in the global workforce management, especially as more companies are embracing decentralized financial systems?
Well, I think it's really looking at flexibility. As you already know, in many countries, the currencies are not very strong. And so cryptocurrency allows employers to have more flexibility to attract talent. Using countries like Argentina, where there's a lot of volatility in their actual currency, cryptocurrency employees are looking to say, hey, I want to work with you, but I'm not comfortable being paid in my local currency. And so this allows organizations who are looking to hire talent abroad, which you already know has been a trend since COVID, to be able to say, look, I can hire talent, I can be able to meet the employee where they're looking at, and I can be competitive in that marketplace.
And with crypto's rise in popularity, it may also come with heightened scrutiny, right? So how is Helios preparing to navigate, these varying regulatory landscapes, especially as crypto policies evolve under the incoming administration?
Well, I want to be clear up front. We are allowing companies to pay us in crypto, and we're taking on that risk and converting that into fiat currencies. But we still have to work with local rules and regulations and regulatory officials to ensure that how we actually pay employees. Right now, many countries do not allow cryptocurrency to be paid to employees as salary income. But we're going to be working with them to see how we can work on that flexibility. But right now, Helios is working with companies to actually take on that risk and actually do the disbursement. Helios can actually issue payments in 150 countries. And so we're able to support that by allowing the first step, which is that conversion of cryptocurrency within our platform.
What would you say are the biggest challenges that you're anticipating when it comes to rolling out crypto payroll funding to companies and their employees?
Well, we don't really see a big challenge in regards to how we're going to receive cryptocurrency. We've looked at ways that we can automate that and make it a lot more simplistic for companies by using their crypto wallets. It's very simple. They'll receive an invoice from us from a payroll requirements. They can convert it and we receive payment that same day. So it's very simple for them. But as we kind of looking at expanding out that offering to our customers, it's going to be working with each and every one of those countries to see where can we pay out in crypto if that's what employees want, or if we have to look at it just from a contractor perspective. Today, we can offer cryptocurrencies to payments to contractors, not to employees. But the fact is, to be honest, if you look at companies who are leveraging cryptocurrency today, they are having to convert, and there's multiple steps for them to do that. Where today, with Helios, they can actually make one payment and we manage all the transfers in 150 countries on their behalf.
Do you foresee any impact that this offering will have on underbanked and emerging markets where crypto adoption has already seen significant growth?
Yeah, you have to think about that. So when you're paying salaries to employees in crypto, the question comes to what is the actual income or taxable income to the individual employee? So that's going to be a challenge because obviously all government authorities are going to want their share from a tax perspective, and you've got to make sure you report that in the correct way. So that's going to be the biggest challenge as we look at payments to employees in crypto. I do want to reiterate, though, our solution here is receiving payments from customers in crypto, and we're doing the conversion to fiat and paying the employees in local currencies. But as we look at expanding that out, the biggest challenge is going to be how do we make sure that we stay compliant in each one of those countries to ensure that the governments receive what they need and the employees are compliantly reported from an income perspective.
Now, briefly, do you think that cryptocurrency could eventually become the dominant method for payrolls across industries, and how does Helios plan to lead that charge?
Well, I think that there's an opportunity there. I don't know if it's going to be the dominant. You got to think about it. Cryptocurrency does create some risk to fiat currencies and possible destabilization of local currencies in different countries. But I do think the flexibility where employers are looking to leverage cryptocurrencies to move money faster, to pay employees faster or contractors faster, I think that's the key right now. So I think there's steps that we have to take. to get there. I don't think this is a tomorrow thing, but Helios is looking at always how do we revolutionize payroll industry and make things a lot more simplistic for employers and how they're actually looking to operate their teams abroad.
Well, we are definitely going to be keeping a close eye on the crypto sector. Thanks again, Rick Hamill. He is Helios founder and CEO.
Pleasure's mine. Thank you.
Coming up, the tech sector and holiday shopping season collide. An expert tells us what consumers are hoping Santa delivers under the tree right after this break.
So now, Chris, tell me about the MLS Innovation Lab program and what it means for Major League Soccer.
So we launched Innovation Lab last year because, MLS has always been at the very forefront of innovation. We were one of the first leagues in the world to launch automated review. We, have our global media partnership with Apple, but we never had a formal innovation program. And so we thought this would be a great opportunity for us to take all the energy from our league, our clubs, our youth leagues, and centralize it and build one central program that we call the Innovation Lab. We see hundreds and hundreds of companies apply every year, and we select the best 6 or 8 to work with us on a 9-month program where they get to really test and try out their technologies. We get to spend time with amazing young founders, and together we get to build the future of sport in North America.
Now, when it comes to evaluating companies to invite to participate in the program and for MLS to potentially invest in, what are you looking for?
Of course, it always starts with what's the idea? Does this founder have something we think is compelling that we can actually use in MLS or in one of our academies? And so that's the starting point. What's the technology? What's the product? And is it interesting to us? And then we do all of the normal things. We spend time with the founding team. We understand, what their vision is, who they are as people. Finances of the company, of course, matter. And then we evaluate all of that, and we go through a deep screening process, lots of cuts, and then come up with the final couple companies.
And tell me, what have been the biggest learnings so far from the MLS Innovation Lab? And personally, what have you enjoyed the most?
So the best is spending time with founders. I mean, you get to do it every day. The energy that startup founders bring is just incredible. Their ingenuity, their drive, their passion. I would highly recommend for any CEO, any executive, to go get out of your office and go spend time in the startup world and bring some of that energy back to your company.
Welcome back to NYSE TV Live. I'm Trinity Chavez in studio. Now, the tech sector is almost always in focus here on NYSE TV Live, and one company is utilizing AI to try and achieve supremacy in analytics. SAS is a multi-billion-dollar powerhouse known for its groundbreaking software and services that empower businesses to make smarter decisions and elevate their performance. For over 50 years, they've been the experts at turning data into actionable insights, earning accolades from Fast Company and the American Business Awards. I had the chance to sit down with Jen Chase. She is their Chief Marketing Officer, to discuss how SAS continues to transform industries and lead innovation on a global scale, on this episode of Taking Stock.
SAS is the leader in data and AI, with innovation at its core. And while we may not be a household name, those in the industry know us well. We are consistently ranked a leader by industry analysts, and our customers have come to rely on us as a competitive advantage to weather every economic storm and evolving technology trend over the last 50 years.
Talk to me more about that, though. How do you really leverage your customers' success through the power of AI?
We know our customers are faced with a rapidly changing technology landscape and vast amounts of data coming at them. So it's our mission to turn that data into intelligence so that they can make decisions at the pace of change that's happening in the market. And you may already be using SAS today and don't know it. If you get an alert from your credit card company that there's been a potential fraudulent charge, that's probably SAS. I know when I shop at one of my favorite stores, Ulta Beauty, I get a personalized experience because of SAS. And when I go to the doctor, I want to make sure the medicines that I'm prescribed are safe and effective. And SAS is the de facto standard for the US FDA, and 100% of new drugs that are brought to market in the United States have been tested for safety using SAS analytics.
And SAS has been around for 50 years as a private company. Why is now the time to explore potentially becoming a public company?
We know we will be attractive for investors. There's very few companies who have made it to the 50-year mark, but even fewer have done it how we have, debt-free and profitable since day one. And so fast forward to today, we're a $3 billion company, and nearly half of that revenue comes from outside the United States. And we also know that this investment in capital that SaaS will get will allow us to have the opportunity to do more technology innovation and give us the brand awareness that we feel is really more befitting to the impact that we've had in the industry.
What's next for SaaS?
We're so excited about all of the attention that generative AI has brought to this space. It's a space that we've been developing and delivering value on for 2 decades. In generative AI, we're already looking beyond large language models at the power of areas like synthetic data. And you can expect us to continue to innovate in the proven and productive AI capabilities, such as machine learning.
And just to clarify, synthetic data is basically recycled data, trusted data.
Yeah, it's a great question. Synthetic data is when you're creating data off of existing data, and you're able to control how that data is created so you can ensure that it's safe and trusted data.
And as AI and technology continue to dominate conversations, they've also become key factors in tackling the challenge of finding that perfect gift for friends and family. Joining us now to help narrow down the search is Antonio Di Benedetto. He is the reviewer, The Verge. Good morning, Antonio.
Morning, Trinity. Thanks for having me.
It's great to have you on the show. So let's just dive right in. What are some of the top 3 tech gifts for 2024 this holiday season, and why did they stand out to you?
So I would say I'd start off with the Ray-Ban Meta smart glasses are a really great pick. A few $100s, so it's a little bit on the pricier side if you're going to give someone a big gift, but it's a mix of a little bit of a wearable with sunglasses that have a camera built in. And, you can take pictures, take video on the go. You can ask, Meta's AI on the go to get like some information in your ears if you want to, if that's your thing, and some listening on the go too. But yeah, that's a really good pick. Or maybe if you're a big coffee lover, the Ember Mug 2 Smart Mug. It's actually a self-heating mug. It's actually my daily mug as well. And yeah, if you're a coffee junkie, can't go wrong there. And then for gaming, I would say the game that just won Game of the Year at the Game Awards last night, if that matters to you, Astrobot on the PS5. Good for kids, good for families, and it's pretty accessible for even hardcore gamers too.
Nice. I would have to say that I love the coffee cup that warms up your coffee. I am a coffee lover, drink it throughout the day, and so it's really handy when you have to just make sure that it's always warm. But we're also seeing a lot of wearable technology, right, when it comes to the health and fitness sector. What are you noticing?
Yeah, there's been a big trend in the ring space, like actual wearable rings, instead of just being everything about a smartwatch. I like a smartwatch, but if you don't want to wear a watch, the Aura Ring Generation 4, the newest model, is a really popular option. Samsung's gone into that space too. It's a space that's kind of growing, but it's a way you can do some basic health tracking and some fitness tracking, but also sleep tracking is one of the strengths of a ring. It's a lot less cumbersome to wear that overnight than it is to wear a big bulky watch.
Have you seen any eco-friendly tech gifts this year that combine innovation with sustainability?
I wouldn't say we have too many picks that are super eco-friendly. The thing is that there's frankly a lot of e-waste when it comes to certain kinds of electronics. So I think it's more about, because I think there's a lot of greenwashing out there. There's a lot of companies that want to talk about how sustainable their products are, but it's really hard to say, especially if a pair of earbuds, for example, wireless earbuds, you want to buy that with the knowledge that one day they're going to maybe go bad and not be really repairable. So I think it's more about the decisions that we make. We got to keep pushing the companies to keep doing whatever they can to be sustainable. But sometimes we got to try and make our own decisions and our own choices too.
We're also seeing a lot of smart home devices continue to grow in popularity. So which ones do you think make this season the best gifts? And are there any surprising new entries?
Yeah, smart home is a popular segment, and I would say that I personally love smart bulbs. I think they're like the easiest entry level into the smart home, aside from say a smart speaker. But I think smart speakers, well, like you can get an Echo Dot from Amazon for like 20 something bucks, and it's they'll just throw them at you because they want to get into your home space and they want to have you using their ecosystem. But I think smart bulbs are a really great option. I use a lot of Philips Hue bulbs, and they're kind of just fun because you can easily change the color, set schedules, set automations probably from your phone, and yeah, they can. You don't need like a whole lot of overhaul of your electrical or anything. Really just plug them in and connect to your Wi-Fi, and you're good to go.
Now, you mentioned some video games earlier on in the show as some of your top 3 tech gifts this year, but what would you say are the latest consoles and accessories and VR systems that are a hot ticket item this year?
Yeah, so Meta just came out with the Meta Quest 3S, which is a lower cost model of their current Quest 3 VR headset. Really great option there as well. If you like VR and AR, if that's something to your liking. But I think in terms of games, the consoles are kind of pretty established between the latest Xbox Series X and the PlayStation 5 and the Nintendo Switch. There is there is definitely a new Switch successor coming in the new year. So if you're late to the Nintendo Switch for family or just for yourself, you have a huge library to pick from. But know that there is a new model coming of some kind. And PlayStation, Sony just launched the PlayStation 5 Pro recently. That is in our holiday gift guide, but it's a $700 console. It's really for like people who are really like pixel peeping. They want the best quality, but in a console versus like a desktop gaming PC.
Now, we have about 30 seconds left here, but quickly, with supply chain challenges and high demand for certain gadgets and products, how can consumers ensure that they get the best deals without missing out on top tech gifts?
Well, first, to follow the Verge deals, because we have a lot of hand-picked deals from our very expert writers who do this stuff for a living. But no, I think, we also have articles about how you can track things. So we're using apps like Keepa or Camel for Amazon listings and getting the best pricing. A lot of stuff is on sale right now. So, it kind of has been because Black Friday was like, it's like a vibe that just continues on since Black Friday started or beforehand. So yeah, I think find what you can in terms of sales and check us out.
Well,
let us know what you think.
A lot of stuff to look out for on my shopping list. I know that. Thank you so much, Antonio Di Benedetto. He is a reviewer at The Verge.
Thank you.
Now we're just about done here on NYSE TV Live, but before we go, I want to wish my co-anchor, Kristen Scholler, a very happy birthday from all of us here at the New York Stock Exchange. Thank you all for watching. I'm Trinity Chavez. We'll see you Monday.
In life, I'm reminded that it's not about the destination. It is truly about the journey.
My pleasure to greet you today from the center of the U.S. capital markets here at the New York Stock Exchange.
I want to just take a minute and not just talk to the people that are in the room, but I want to speak to the rest of the team around the globe. These are people that made this happen, and I know that there is no way we would be here if it wasn't for you.
Everyone at Flutter is proud to join such a distinguished list of companies on this great stock exchange. Not many people get to do something big in this world, and we get to do something truly special.
This is such a wonderful place to both look back and look forward. Look how far we have come. I'm so optimistic about what lies ahead. It has been a privilege to be with you.